Welcome to the Explainer. So, you've put your money into a mutual fund. You're buying a tiny piece of this giant investment pie. But have you ever stopped to wonder, how is the price of your slice actually decided? Today, we're going to break down the three key numbers that are running the show behind the scenes: NAV, TER, and the final price you pay.
It's the big question, right? The one every single investor asks themselves. What did I actually buy? And how does its value get calculated day in and day out? Well, I promise you, it's not some kind of financial magic. It's just math. And once you understand it, you'll be able to track your investments like a pro.
Okay, let's get right into it, starting with the most basic, most fundamental number of all, the net asset value, or what everyone calls the NAV. The easiest way to think about this? It's the true official price tag for one single unit of your fund.
To put it really simply, imagine if, at the end of the day, the mutual fund decided to sell everything. Every stock, every bond, all of it. Then they pay off all their bills and expenses. The money that's left over, divided by all the units everyone owns, that is the NAV. It's the real, honest-to-goodness value, and it gets a fresh calculation every single day.
Now, this table might look a little complex, but the idea behind it is actually pretty straightforward. You just take everything the fund owns, all its assets, and add them up. Then you subtract everything it owes, its liabilities, like fees. That gives you the net assets. Divide that big number by the total number of units out there, and voila, you've got the NAV per unit. Simple as that.
And this is a really important distinction to make. An NAV is not a stock price. A stock price is this wild roller coaster, changing every second based on what buyers and sellers are willing to pay. The NAV, on the other hand, is calm. It's a calculated value, based on the actual stuff inside the fund. It's only calculated once after the market closes for the day.
Okay, so we've got the NAV down, but if you were paying close attention to that last calculation, you might have noticed that little line item for fees. Well, let's zoom in on that, because every fund has running costs. And in the world of mutual funds, these costs are all wrapped up in one number, the total expense ratio, or TER.
Of course there are. You know, running a massive, professionally managed investment fund isn't exactly free. You've got to pay the fund managers, the administrators, the marketers, and all those costs come directly out of the fund's assets. They're taken out before you ever see that final daily value.
The TER is basically an all-in-one fee. It covers the whole shebang. You've got the big stuff, like the fund manager's salary and brokerage fees, but it also covers all the little things, right down to the cost of printing and mailing you an account statement. It's the annual price tag for owning that fund. So here's the kicker, and this is the part that really matters for your money. Those expenses are taken out of the fund's assets every single day before they calculate the final NAV. So it's simple. A higher TER means a lower NAV, and a lower NAV means lower returns for you. A 1 or 2% fee might sound small, but trust me, over time it's a huge deal. That small percentage can eat away at thousands, even lakhs, of your final returns. It's like a silent drag on your investment's engine.
Now, the good news is this isn't the Wild West. Regulators like SEBI have stepped in to protect investors like you and me. They've put caps on how much a fund can charge. And what's really cool is how it works. As a fund gets bigger and manages more money, the maximum percentage it can charge actually goes down. It's called economies of scale, and it means the bigger the fund, the more of those savings get passed on to you.
All right, so we've got the daily value, the NAV, and we've got the daily running costs, the TER. Now let's talk about the one-time fees you might run into when you buy or sell. These are called loads.
Let's start with some fantastic news. Back in the day, funds could hit you with an entry load, which was basically a fee just for the privilege of investing. Well, guess what? SEBI banned them completely in India. Gone. So you always get to invest at the exact NAV. What you do still need to watch out for, though, are exit loads.
An exit load is pretty much what it sounds like, a fee for leaving too early, usually within the first year. Now, it's not really there to punish you, it's more of a way for the fund to encourage long-term investing and discourage people from jumping in and out, which can mess things up for all the other investors.
Okay, theory time is officially over. Let's make this real. Let's pull all three of these big ideas together, NAV, TOR, and loads, and walk through a simple investment journey to see exactly how they work together to decide how much money you actually get back.
So it all starts with your purchase, right? You put your money in and you get a certain number of units. Then time goes by. The fund grows, which is great. But remember, Every single day, that little TER is being nibbled away, slightly reducing the NAV. And then, finally, when you decide to sell, that's when any exit load gets subtracted from your total.
And here's where the rubber meets the road. Let's do the math. Your 1,000 units are now worth 12,000 rupees. Fantastic. But wait, that 1% exit load kicks in, taking away 120 rupees. So the final cash that actually hits your bank account is 11,880. This shows it perfectly. Your return is never just about how much the NAV grew. It's what's left after all the costs. So why did we just go through all of this? Why do these numbers matter so much? Well, because understanding them is what separates a passive passenger from an informed driver of your own financial future.
Look, if you remember nothing else from today, just burn these points into your brain. NAV is the price. TER is the annual cost of ownership. And exit loads are possible fees if you sell early. And that last point on the slide, that's the whole ball game. These three things working together are what determine your actual take-home return. That's the bottom line.
And that's really what this is all about. It's about empowerment. Once you get how these things work, you're not just along for the ride anymore, hoping for the best. You're in the driver's seat. You're the one holding the map and navigating your own path forward.
And that leads us to the ultimate, most powerful question you can now ask yourself. When you look at a fund's amazing performance numbers, you can now dig a little deeper. You can look at its TER, check for an exit load, and decide for yourself. Is that performance really worth the price? Being able to answer that question is a total game changer.